related to the St. Louis Fed's video called the Fed in Plain English. Please watch that video first before we proceed. The Fed in Plain English gives a nice overview of what the Federal Reserve is, how it works, and what is monetary policy. This video is about money supply, money demand, and the mechanics of monetary policy in theory. So again, please watch the Fed in Plain English video first before going on to this one. So again, we're going to be sharing the screen over here. Just give me a moment to get everything all nicely set up there. And so we're going to share that screen and we're going to continue. We're talking about monetary policy here in just a moment. All right. I just love to use these when I can, mainly because of the fact that they're a little less cumbersome. First of all, we have to talk about the M1 money supply and money demand. In order to understand how the Federal Reserve influences total spending in the macroeconomy, it's first important to understand the macroeconomic principles of financial markets. First thing, there is a money supply curve called M1, which represents only spendable assets in the macroeconomy. Spendable assets in our economy are cash itself, paper banknotes and coins, and balances in checkable accounts, which we call demand deposit accounts. That includes money in checking accounts, prepaid gift cards, and traveler's checks. We have a money demand curve that represents consumer, businesses, and banks' desire to keep spendable assets on hand. An asset is anything that holds value over time, and that obviously includes currency and balances in checkable accounts. Also includes real estate and financial investments, but we're dealing only with what we call liquid assets. Liquidity refers to the direct spendable nature of an asset, or how easy or how difficult it is to convert a non-spendable asset like a savings bond into a spendable asset like cash. The interest rate is the price paid by our borrower for the use of loan funds, finance charges, as I like to say. It's a price paid to a saver by a bank or financial institution for the use of the saved funds. Typically, the interest rate charged on a loan is a lot higher than the interest paid on a savings account, which sucks for the savers and the borrowers alike. Now, I've mentioned this before, M1 money supply, only the directly spendable, highly liquid money, in other words, highly spendable assets circulating out there. Currency, paper money and coinage, about 55% of M1, and demand deposits, money in checking accounts, prepaid gift cards, traveler's checks, balances in checkable accounts, about 45% of M1. The M1 money supply graph, first of all, is a vertical line, because it is independent of interest rates, which are the price paid to borrow money. There's a quantity of money circulating. I don't know what just happened there. A quantity of money that's circulating in the economy here. And the M1 money supply increases by shifting right, decreases by shifting left. Main thing I want y'all to know about the M1 money supply is that it is highly, highly, highly volatile, meaning it changes frequently. It can change by a large margin. Now, there are three big entities out there that influence M1. First, the central bank. That's the Federal Reserve, or the Fed for short. They influence M1 money supply through monetary policy. Second, the public at large, private citizens and businesses through financial investment, borrowing, spending, liquidating assets, saving, etc. We influence M1. Last but not least, the commercial banking system. Private banks like Wells Fargo or Chase, through lending or buying or selling securities, meaning government bonds specifically, they can increase or reduce M1 as well. I always tell people, imagine a three-way tug of war between Dwayne Johnson, The Rock, a bull, and a F-150 pickup truck, and they're all pulling in different directions, sometimes the same. That kind of a three-way tug of war is part of what creates the volatility of M1. Very often the Federal Reserve gets what it wants, but it doesn't do so without collateral damage, because you know that the pickup truck and the bull are going to dig in as hard as they can. Just consider that just really carefully as I mentioned this here. Money demand has two parts. The transactions demand, which is a vertical line, independent of interest rate. It's the money that people keep in their checking account or in cash, businesses in their cash registers and in their petty cash to conduct day-to-day transactions like buying lunch, paying bills, paying staff. The asset demand is a negatively sloped type exponential curve. And I want you to notice the slope is steep when the interest rates are high. The slope is nearly horizontal when they're low. It's about 45 degrees somewhere in the middle. This is money kept in a checking account or held as cash for its intrinsic value as an asset, not to be used for transactions. These curves don't shift. They're fixed. And the total demand for money looks like I took the asset demand, kicked it over to the right by an amount that equals transactions demand, and that's exactly what I did. It's a horizontal summation of the two. As the money demand curve does not move, money supply moves a lot. So one of the things to understand is the Federal Reserve is able to influence and move the M1 money supply, and that's going to change the financial market equilibrium. The intersection of M1 and MD shows an equilibrium interest rates. The prime lending rate, which is like the master rate of interest, all other interest rates like credit card interest rates, mortgage interest rates, bond rates, and so forth are prime plus a markup or minus a mark down, depending upon what it is. But the bottom line here is the Fed starts to move M1 around. Interest rates on everything change. And that has the keyword potential to influence, to change total spending. The Federal Reserve, or the Fed for short, cannot change total spending directly. They have the ability to change the amount of spendable assets in the system. They can make it easier or more difficult for banks to lend money. They can make it cheaper or more expensive for people to borrow money. Here is ultimately the public and the banking system keep their own conscience. And if one or both of them don't cooperate with the Fed, spending is not going to change. So that's a potential problem already to know about. Monetary policy refers to actions taken by the Federal Reserve or by a nation's central bank to influence the economy through influencing total spending. Unlike fiscal policy, monetary policy is more indirect because it requires the commercial banking system and the public at large to cooperate with the Fed in order for total spending to change, and that does not always happen. The main tools of monetary policy are, first of all, open market operations. Second of all, changing three different key interest rates. Third, changing the required reserve ratio, which the Federal Reserve has not done since the early 1990s, I might add, but it could do so potentially in the future. Quantitative easing was an experimental tool that was attempted for about 4 years, but it did not work and has been discontinued and has not been used since. And according to this economist, should never have been used, but I digress. Let's go into more detail and talk about what each of these are. Open market operations means the Federal Reserve is buying or selling government securities. I mean U.S. government bonds, treasury bills, treasury notes, savings bonds on the open market. When the Fed buys securities from the public, meaning private citizens and businesses, they pay the people and the businesses. Money ends up in their checking accounts. That's a spendable asset. It could potentially lead to more spending. When the Fed buys securities from commercial banking system, they pay them by putting money in the bank's reserves. The reserves on the commercial bank's balance sheet are a source of lendable assets. And so if banks have more reserves, they can lend more money, and it may lead to more lending and therefore more spending. Now, the flip side, the Fed could sell securities to the public, which will take money out of checking accounts and reduce the amount of spendable assets out there and therefore reduce spending. Or the Fed could sell securities to commercial banks, which will take away from the bank's reserves and their ability to lend money. That should reduce spending. Now, the key interest rates. First two, I sub D stands for discount rate. That's the rate of interest the Federal Reserve will charge a commercial bank on a so-called overnight loan. Commercial banks have to have a minimum balance in their reserve account. If they're running short, they may borrow a few $1,000,000 from the Fed for the next 24 to 96 hours. And during that time, they're charging an interest rate that's currently around 0.85. Actually, no, pardon me, about 1.15% right now. Excuse me, it's 2018 now. That would still be tens of thousands of dollars in interest for that short-term loan. The federal funds rate, I do not know why this thing is acting so cuckoo here. I think I must have hit the tracking table here. I apologize. Federal funds rate is the rate of interest one commercial bank is allowed to charge another commercial bank for a short-term overnight loan, 24 to 96 hours. Bank of America is running short on reserves. Bank of America could borrow money if Wells Fargo has excess reserves to lend. Borrow a few $1,000,000 from Wells Fargo, and they have to pay Wells Fargo for about 3 or 4 days worth of interest to the tune of 1.5% APR. Again, for a few days, it could be tens of thousands of dollars in interest they pay them. But the bottom line here is when the Fed changes the discount rate, they change the federal funds rate at the same time and in the same direction. Whenever the Federal Reserve raises the discounted federal funds rates, it makes interest rates on loans, credit cards, bonds, and savings accounts rise. Basically, the costs get passed on to the savers and the borrowers alike. For the savers, an increase in discounted federal funds rate is a good news because it means higher interest rates on savings accounts. For the borrowers, especially credit cards that have variable interest rate, that's bad news. I guarantee you that when the Fed raised interest rates a couple of weeks ago, everybody with a credit card got a letter saying, guess what, we're raising your interest rates. The thing is, as those interest rates rise, it discourages people from borrowing and spending money. It discourages business from borrowing and spending money, and this can make spending decrease, potentially. If the Fed lowers those interest rates, it makes interest rates on loans, credit cards, corporate bonds, and savings accounts drop, which would encourage people and businesses to save less, spend more, especially borrow and spend. Well, that's if the banks are going to lend money at those lower interest rates, and they may not. Interest on reserves is something the Fed started doing recently, mainly because there was so much money in reserves due to a bunch of actions from quantitative easing that's the result of Benjamin Bernanke, that they started basically paying interest on reserves. In 2012, the rate of interest on reserves was 0.25% per year, and that essentially raised the Fed's cost of operating by quite a bit. Currently, interest paid on reserves is 0.05%, and they're about to move it down to zero based upon stuff that I've read here. The Federal Reserve has been trying to push banks to not hold so much money in reserves anymore for the last several years, partly as they have corrected for quantitative easing. Give it a few more years for reserves to get more normal. You're not going to see interest paid on reserves. But this one, if the Fed is going to raise those other two interest rates, they typically will raise interest on reserves. Recent behavior is an odd exception, though. How monetary policy gets used. The two main tools of monetary policy the Fed uses are open market operations, buying or selling government bonds, and which is what open market operations is, raising or lowering key interest rates. If you have a recession, like that second scenario we had, the Fed would use easy monetary policy. What the Fed is going to do is shift the M1 money supply to the right, make it increase, which will make interest rates drop. If interest rates drop enough, people and businesses save less money and spend it instead. Or they try to borrow more money, people and businesses, which may make consumer and gross private investment spending increase, which could make AD shift to the right, real GDP increase, and unemployment rates drop. The stuff in green is the stuff the Fed can do for sure. The rest of this depends upon if the banking system cooperates and the public cooperates. To use easy monetary policy, the Fed would buy securities from people, buy them from businesses, and buy them from banks. This would put more spendable and lendable assets out there. If this isn't working well enough, they would lower key interest rates, the discount federal funds rate, maybe even interest on reserves. By lowering those key interest rates, it makes the cost of borrowing drop. People want to borrow and spend more. Businesses want to borrow and spend more. It makes the interest on savings drop, so people and businesses don't want to save as much money. I've crossed out lowering reserve requirements because the Fed has not changed the required reserve ratio in over 20 years and has no plans to change it. The Fed could do this. I just don't see them doing it. 10% is where it's been locked in for almost 28 years now. Tight monetary policy is used by the Fed to fight or prevent inflation. M1, shift it to the left to make interest rates rise. As interest rates rise, people save more and borrow and spend less. Consumer spending drops. Businesses borrow and spend less and save more. Gross private domestic investment spending drops. The aggregate demand curve as spending drops would shift to the left, causing a drop in the consumer price index and a drop in the rate of inflation. For the Fed to do this, they would first sell bonds to people to take away spendable assets, sell bonds to businesses and banks to take away spendable and lendable assets. If that doesn't work, or if they run out of bonds to sell, they can increase the discount rate, increase the federal funds rate, interest paid on reserves. Increasing the key interest rates makes all the other interest rates on loans and credit cards rise. People and businesses don't want to borrow as much, but it's more expensive to borrow money. Interest rates on savings accounts rise. People and businesses that save will want to save more. Okay. Bottom line is, if this is done the right way, spending will drop. Now, I have crossed out increased reserve requirements, but I want to mention something. During the late 1970s, when we experienced very bad cost push inflation, not demand pull, cost push, The Federal Reserve raised the reserve requirement very gradually over 5 years to where it went from about 10% to right around 20%. And interest rates were skyrocketing as a result. It was great if you're buying bonds or saving money. Banks wanted to lend at high rates of interest, but they had no lendable funds because they were trying to make sure that they were meeting the higher reserve requirements. After that inflation was corrected, the Federal Reserve gradually lowered interest rates down over a decade until they locked them back in at 10% in the early 1990s. If we ever had such crazy rates of inflation as we had in the late 1970s happen again, the Federal Reserve could start raising them. But it's just that based upon the recent 28 years, I don't see them changing it anytime soon. Now, let's talk about the possible impact. We recognize the graph on the left as a recession. Okay, I'm not going to go through how we got there because we've had previous videos about that. M1MD is starting in the middle, so we at least get some action, some changes in interest rates. The Fed increases M1 by buying securities through open market operations from people, businesses, and banks, and lowering the key interest rates. If the banks and the public cooperate, M1 shifts to the right and interest rates continue to drop. As this happens, consumer spending will increase due to a drop in consumers' indebtedness and a decrease in consumer savings. Investment spending increases because it's cheaper for businesses to borrow money to buy new physical capital. That is, of course, assuming the banks actually lend the money. If this does happen, though, I'm not saying it will, but I'm saying if it does, spending increases, the ED curve shifts to the right, real GDP gets bigger, and we start to see a recovery. But I want everybody to please notice the statement on red. In practice, this does not happen because the banking system will not cooperate with the Fed. Class, as somebody who worked in banking for 8 years, I can tell you a couple of things. When banks lend money, they do so to make a profit. Banks make more profits from loans when interest rates are higher. When interest rates drop, loans are less profitable. So the Fed may want people to borrow more money, and people do want to borrow more money at lower interest rates, but banks are going to say, we don't want to lend money at low interest rates. Now, that's part of the problem. The second part of the problem is during a recession, people are a lot more likely to become unemployed. And somebody who's borrowed money from a bank suddenly loses their job will probably default on the loan, and the bank will not get its money back, let alone any profit from the interest. And the Fed can't make banks lend money to people and businesses that might go bankrupt and fail to repay the loan. They can't hold a gun to the bank's head and force them to do so. And so it's one of those situations where interest rates get lower. People and businesses want to borrow more money, but banks say, we don't want to lend money. In practice, easy monetary policy really isn't that effective to deal with a recession, and that's unfortunate. Now, tight monetary policy, on the other hand, is a great strength of the Federal Reserve. When there is inflation, we have historical proof that over many times when inflation started to rear its ugly head, if the Fed starts tightening up the credit market using tight monetary policy, inflation gets corrected very well. Again, this is that first scenario we had 2 videos ago where spending went up and we had a bad case of demand pull inflation. The thing is, the Federal Reserve starts using tight monetary policy. They sell securities, they sell government bonds to people and businesses, which take away spendable assets. They sell bonds to commercial banks, which reduce their excess reserves and take away lendable assets. If that doesn't work fast enough, they start raising interest rates, and people that don't want to save suddenly want to. People that borrow money suddenly don't want to borrow so much anymore, although the banks probably still want to lend. But the bottom line is, as those interest rates go up and as their spendable assets are taken away, M1 goes right, and interest rates rise even higher. Those higher rates of interest make consumer spending decrease. If you have a credit card and they raise your interest rate, you start to accumulate debt faster. Okay? Similarly, as interest rates rise, people that want to save will get a better return. They don't want to keep as much money in a liquid form. They'd rather buy a bond or put it in a savings account where they can earn a return on it. Investment spending, gross private domestic investment spending will decrease because it's too expensive to borrow money for businesses to buy capital resources, and those businesses that do save will want to. The banks will probably be a little bit pissed off because they want to lend money at higher rates of interest, but if people don't want to borrow, oh well. The AD curve will shift to the left, and as it shifts to the left in that classical segment, we see a drop in CPI, and we see inflation corrected. Now, please notice the comment at the bottom. In practice, this works very consistently, but it's not a scalpel. It's a blunt instrument, more like a club wrapped up with barbed wire, like old Negan from The Walking Dead. It's going to have an effect, but just like that club, Lucille, it's going to do some collateral damage. I hope y'all have noticed that a big difference between the fiscal and the monetary policy is we've got 3 graphs instead of 2. We're showing the problem on the first graph for ADAS, and we're showing the solution, the impact on the second ADAS graph. But that graph in the middle, the M1MD graph, distinguishes monetary policy from fiscal policy. The Fed cannot directly change total spending. The Fed can directly change M1 and interest rates. But the second ADAS graph will only happen if the public cooperates with what the Fed's trying to encourage them to do, and if the banks cooperate with what the Fed is trying for them to do. Obviously, this is the theory side, so we're assuming that the public and the banking systems do cooperate. But what you're going to hear about a little later on is in real life, that doesn't always happen. As you've probably noticed in my verbal commentary, ... Okay, so we're going to stop sharing the screen. And we're going to go back to our closing here. This is just theory. This is just theory. And I'm going to say this, both fiscal and monetary policy very often work the way theory says it would. But again, it's not without some collateral damage. It's not without some spillover problems or externalities that rise up. We're going to deal with those in our next video. Thank you all very much, and I'll see you later.